The Entrepreneur's Mind, Obsession with Building from Zero. How founders think differently, take risks, and create value from scratch. Let's face it, most normal people don't wake up and think, you know what sounds fun today? Leaving a stable job, risking my savings, and trying to convince strangers on the internet to buy my homemade AI-powered sock warmer. But entrepreneurs, they're a different breed. These are the rare folks who see a blank page, a chaotic market, or a garage full of questionable tools and say, yep, this is the dream. 1. Zero isn't nothing. It's possibility to most. Starting from zero means, well, zero, nada, nothing. To a founder, zero is the ultimate creative playground. No rules, no red tape, no boss saying what, but that's not how we do things around here. Because guess what? There is no around here yet. It's like playing SimCity with unlimited imagination and zero power plants. Ikinci risk? What risk? Entrepreneurs treat risk like seasoning. Too little? It's bland. Too much? It might burn, but at least it's exciting. Where others see danger, founders see opportunity. Where others say, this could fail, they whisper, yes, but what if it doesn't? They jump off cliffs and build parachutes on the way down, then sell those parachutes to other cliff jumpers. 3. The startup mindset, delusion meets strategy. There's a thin line between visionary thinking and delusion. Founders tightrope walk that line daily, in flip-flops, holding a pitch deck. They believe in things no one else sees. They stay up late obsessing over UI tweaks no customer will ever notice, because they notice. And that obsession? That's the secret sauce. Also caffeine. Lots of caffeine. 4. Value creation, turning chaos into gold. Starting from zero means building value from the raw elements. Problems plus grit plus questionable Wi-Fi equals startup magic. Entrepreneurs don't just solve problems. They sniff them out like innovation bloodhounds. And when they find one, they say, let's build something people can't live without. Or at least something they'll awkwardly subscribe to for $9.99 a month. 5. Failure? A feature, not a bug. Every founder has a story that starts with, so we totally crashed and burned, but. Failure isn't the end, it's market research. It's part of the journey, the cost of entry, the badge of honor they wear like, yes, I lost half my eyebrows in that prototype fire, but look at this new version. It's flame resistant. So why do they do it? Why endure the stress, the setbacks, the 3 a.m. debugging marathons? Because they can't not do it. Building from zero isn't just a career path. It's a mindset. A slightly unhinged, wildly creative, endlessly curious way of looking at the world and saying, I can build something better. What about investors? The investor's edge, making money work while you sleep. How investors analyze risk, seek returns, and build wealth without lifting a finger at 2 a.m. Let's get one thing straight. While you were snoring with your mouth open last night, some investor out there was earning compound interest. Yup. Making money while you sleep isn't just a cliche. It's the entire point of investing. And no, it's not magic. It's not a lottery ticket. And it definitely doesn't involve crypto coins named after animals. It's strategy, patience, and just a dash of spreadsheets. 1. Investors think in decades, not paychecks. The average person asks, how much do I make this month? The investor asks, how much will my money make me by 2035? If I stop buying overpriced coffee and invest it instead? That's not just discipline. That's future you doing high fives with present you. Ikinci risk? It's not a scary word if you know it. To non-investors, risk sounds like a horror movie. To investors, it's a math problem. They don't avoid risk. They measure it. They tame it. They say things like, what's the Sharpe ratio on this? While the rest of us are still Googling what a bond yield is. They play chess while others are playing checkers with monopoly money. 3. Passive income, not lazy, just efficient. Let's be real. Investors aren't working harder. They're working smarter. While you're sweating through back-to-back Zoom calls, their index funds are casually compounding behind the scenes, like a financial crockpot. Set it. Forget it. retire early, and no, it's not overnight wealth. It's get rich slow, which surprisingly actually works. 4. Diversification, because eggs in baskets. Ever heard the phrase, don't put all your eggs in one basket? Yeah, investors live by that. They spread their capital across stocks, bonds, real estate, even solar-powered goat farms in Vermont, because the more baskets you have, the less likely you are to trip and end up with financial omelets. 5. Sleep is the new side hustle. Investors love sleep because while they're drooling on their pillow, their portfolio is doing all the heavy lifting. Dividends dripping in. Real estate gaining value. That ETF they bought in 2020, it's now paying for brunch. They're not chasing money. They've trained money to chase them. So what's the secret? No, it's not a secret stock tip from a guy named Vinny in a Discord channel. It's not timing the market. It's time in the market. Smart investors study, stay consistent, avoid panic selling when the market sneezes, and let compounding interest do its thing, like a patient little wealth robot working 24/7. Final thought? Being an investor isn't about luck. It's not even about having tons of cash. It's about mindset. It's about thinking long-term, managing risk, and understanding that the best kind of money is the kind that works while you sleep. So go ahead. Get some rest. Your future self is already thanking you. How do investors manage risk? Risk appetite versus risk management. The clash of business philosophies. Entrepreneurs chase uncertainty. Investors try to cage it. Who's got it right? Let's imagine risk is a wild animal. An entrepreneur sees it and says, let's ride it. An investor? Let's tag it, track it, and put up a fence. Same beast. Two very different approaches. Welcome to the great philosophical tug of war. Risk appetite versus risk management. 1. Entrepreneurs, the thrill seekers of uncertainty. Entrepreneurs don't just tolerate risk, they practically date it. They build startups with 2% survival rates. They max out credit cards for ideas written on napkins. They hear this might fail and respond with, perfect, let's make it happen. For them, risk is fuel. It's what separates the bold from the boring. They live by a simple creed, no risk, no story. 2. Investors. Risk is not a hobby, it's a spreadsheet. Now enter the investors. These are the folks who say things like, what's the downside, before they say hello. To them, risk is a variable, a number, a thing to be hedged. They like forecasts, they crave historical data, and they break out in hives when someone says, we're pivoting based on a gut feeling. Investors build guardrails. They create backup plans for their backup plans. And when chaos hits, they already ran the simulation 6 months ago. Third clash of the philosophies, cowboy versus chess master. In the Wild West of business, the entrepreneur is the cowboy, riding fast, living bold, hoping the next hill holds gold, or at least Wi-Fi. The investor, the chess master, watching patterns, calculating 3 moves ahead, polishing their risk models like their vintage vinyl. They admire each other from a distance. Entrepreneurs think investors are too cautious. Investors think entrepreneurs are one espresso away from implosion. And you know what? They're both kind of right. 4. Who wins? Spoiler, they need each other. Here's the twist. Startups need investors need startups, and both need a healthy relationship with risk. Because risk isn't the enemy, it's the test. It's the price of innovation. It's the toll you pay to cross the bridge from safe to significant. Entrepreneurs take the leap. Investors make sure they've packed a parachute. Together, they build rockets that don't explode, most of the time. So, what's the takeaway? You don't have to pick a side. Whether you lean more thrill seeker or spreadsheet guru, the truth lies in the balance. Take smart risks, prepare for the worst, hope for the moonshot, manage the turbulence. Because in the end, risk is where business gets interesting. And how you handle it, that's what sets your story apart. From founder to funder. When entrepreneurs become investors, why successful builders eventually switch sides, and how their mindset evolves. At some point, after years of chaos, caffeine, and pitch decks, the entrepreneur looks around and says, Wait a second, do I have to keep starting companies? Or can I just fund other people's madness for a change? And just like that, the founder becomes the funder. Yes, it happens. And when it does, the risk-taking, sleep-deprived builder transforms into something different, still ambitious, still hungry, but now with spreadsheets and equity stakes. Let's explore this beautiful metamorphosis. 1. The startup survivors glow up founders who make it often carry the battle scars. They've launched, failed, launched again. They've demoed at 2 a.m., sold products before building them, and eaten way too many investor lunches involving tiny sliders and big promises. Eventually, they reach escape velocity. The startup succeeds. There's an exit, a big one. And then they join the other side of the table. But here's the twist. They don't become your typical investor. They become what you might call a founder-sourced funder. 2. What changes and what doesn't? What changes? They now ask you the tough questions. They carry moleskins instead of mock-ups. Their risk appetite becomes a risk portfolio. But deep down, they still get it. They've been in your hoodie. They've debugged at midnight. They've begged a friend to pretend to be head of ops on a call with investors. So when they invest, they don't just bring money. They bring empathy, experience, and occasionally, snacks. 3. Why do founders become funders? Simple. They want to stay in the game. Without burning down their adrenal glands again, they've learned that building from scratch is thrilling, but mentoring someone else, building from scratch, also thrilling, and slightly less panic-inducing. Plus, investing lets them scale impact. One founder can build one startup, but one funder, they can back dozens. It's the ultimate entrepreneurial side quest. 4th, founder funders think differently. They don't just chase safe bets, they spot the chaos they used to be. They don't flinch when you say, "We don't have revenue yet, but we have a Discord full of angry superfans." They nod, they smile, they remember. They bet on the person, just like someone once bet on them. 5. Full circle, builders fueling the next generation. At its core, this shift from founder to funder is a full circle moment. Yesterday they were pitching. Today they're listening. Tomorrow